Okay, hi everyone. My name is Rajiv. I'll be doing this presentation on how do we turn risky investment portfolios, retirement portfolios into guaranteed lifetime income, right? And the goal of that, right, is twofold. One, provide us with more retirement income and for us to spend, as well as to have more wealth and after-tax wealth in the later years of our life, or that we can pass on to beneficiaries. So those are the two goals we'll be really focusing on, and how guaranteed lifetime income helps us achieve both of those goals through our retirement planning process. So I'm just going to wait a minute or two for a couple people to trickle in, and then we'll get started. A couple housekeeping items. There's a chat here. If you have questions, feel free to type in the chat. I'll try to get to it during the presentation, but more likely than not, it'll be towards the end of the presentation. We'll just wait a couple minutes here. Okay, so let's go ahead and get started. Again, if you have questions, please type it in the chat. Hopefully everybody can hear and see the screen. If you can't, please let me know in the chat. But let's go ahead and get started. So again, what are the two takeaways? If you guys take only two things from this presentation, it's hopefully these two. One, how to manage risk so you can spend more in retirement. And this is super important because obviously we each have a risk tolerance, right? Super conservative versus super aggressive. But one of the things I want to educate you on in this presentation is it's not so much about taking more risk. It's about understanding it and structuring it so that you can accomplish your goals. You can spend more in retirement simply by understanding how to manage it, right? Again, if you think at high level, like you have taxable accounts, you have retirement accounts. How do I use that? So that's not taking more risk. It's just understanding how to structure risk. And the way the analogy I like to use, it's like risk can be a 4-letter word, but so can fire, right? So the question is fire a good thing or a bad thing, right? In the wrong hands, right, it can burn down a whole village. But in the right hands, when constructed properly, right, it can warm that entire village up. So it's really just about how you manage risk. And we'll be talking about it here later on in the presentation. Then the second thing is obviously reducing taxes, right? One of the things guaranteed lifetime income does is it allows you to defer taxes when you're in a high working environment, right? High tax rate, to when you're in retirement in a lower tax bracket. And this ability to reduce taxes, particularly on your fixed income, your bond portfolio, which we'll be talking about here on this presentation, is what allows you to get more after-tax income from your fixed income portfolio, which means you need less from your equity portfolio, which means you're able to allow that to compound more over the long term. So these are the two kind of goals: how to manage risk, right? How do we just think about it differently, not take more risk, but structure it differently so we can improve our retirement outcomes. And then the value of tax planning and just thinking about this a little bit more strategically, right? So these are the two goals I'm hoping that you guys take away from this during the course of the presentation. So ultimately, it's financial planning, right? How do we use financial planning? How do we use the tax code to our benefit? How do we understand that some people don't make the best decisions, and we can, us making proper decisions, benefit as a result of that? So a little about me and my firm, depending on where you found me, whether you're dialing in through Twitter or LinkedIn, I'm an actuary by planning. I talk and present a lot about retirement planning. If you Google Colva retirement planner, Rajiv Rebello retirement planning, you'll see some of my work. And I talk about these things with regards to the value of embedded options, the value of guaranteed lifetime income. How do we strategically understand how to structure risk? How do we understand the value of financial planning, right? Retirement accounts versus taxable accounts. And how do we use this? How do we use the laws and kind of the economic benefits of vehicles, right? Ultimately, these are vehicles. Right? Guaranteed lifetime income is a vehicle, a Roth IRA is a vehicle, right? A taxable brokerage are a vehicle. How do we use these vehicles to improve retirement outcomes, right? So obviously, this is a very niche element, guaranteed lifetime income, but it is part of a larger retirement planning picture. And ultimately, when you think about this, I don't want you to think about this in isolation. Guaranteed lifetime income is an awesome tool, but you have to understand how it fits into the larger play of retirement planning, right? You want to incorporate, this is just one part of the wheel. So obviously, we'll be talking about a number of things here that's important to understand. A couple things. The first is we'll be talking about economic stock returns, bond returns. And whenever you talk about historical returns, it's important to understand that past performance is not indicative of future results, right? It doesn't guarantee that the future is going to look exactly like this, but anytime we look at history, it's important to understand, well, do we see trends? What can we learn from history to make better decisions going forward, right? So not a guarantee of future results, but it really helps us to understand how economic systems work and like how to prepare and protect against them. Remember, we talked about managing risk. That's why we'll be talking about past performance, mainly of the stock market and fixed income portfolios. Obviously, this is educational information. Educational information is general. Investment advice is specific to you. So this is not specific investment advice. It's just really an educational platform that's general, right? Now, we do provide investment advice, tax planning, and insurance solutions, right? But that, again, has to be specific to you and your need. This is just showing how these tools, in this particular case, guaranteed lifetime income, can be of value to you in your retirement planning process, right? So just keep this in mind as we go through the course of the presentation. So let's start. Well, what is a guaranteed lifetime income product, right? That's what we're here today. Let's just understand what we're all starting with on the basis, or the basics rather. So a guaranteed lifetime income product provides you with a guaranteed amount of income every year for the rest of your life, right? So that's a pretty simple definition. And we can think of things like Social Security, right? Gives us a guaranteed amount every year. A pension, back in the days when we had pensions, provide that to you. But that's essentially what a guaranteed lifetime income product is. We'll be talking about a specific guaranteed lifetime income product that comes not from the government like Social Security or the company you work with a pension, but from an insurance company. So in order for the insurance company to provide these guarantees, billions of dollars of reserves need to be held and invested safely in long-term bonds. So this is not entirely different than Social Security, right? It's that money is, there's reserves that back the guarantee you're getting, when you retire and collect Social Security. So with insurance companies, it's very similar, right? They're investing in safe long-term bonds. They have long liabilities, right? So that they're holding, so that they can afford when those coupon payments come due. They're holding onto it. That's their liability, and they're paying you the proceeds. So why is current guaranteed lifetime income at risk, right? So obviously, company pensions have gone away in the place of 401ks, and part of the reason was the cost of maintaining that was really expensive for insurance for companies, because they had to essentially reserve for these long liabilities, right? So companies were not actuaries, right? They were not in place to make these decisions and hold this amount. And they realized they were really getting burned because people obviously were living longer, and they were paying the cost of it. So that went away in the place of 401ks, which just shifts investment risk, right? It shifts investment and longevity risk away from the company and towards the individual, right? Like, which is great if you're the company, because that's a liability they no longer have to worry about. But if you're the employee, that's now something you have to take on. And obviously, if you don't have the investment understanding, that's part of the risk that's now on your shoulders, as opposed to the company you work for. Obviously, Social Security fund, it's the trust fund scheduled to be depleted, which would be a 17% reduction in benefits compared to today. Social Security is not, of course, going away. More than likely, they'll raise payroll taxes to compensate for this. But the point being is understanding, like, look, this is an expensive liability. In order to provide this benefit, you really have to reserve. You have to be in the business of reserving and understanding actuarial tables, policyholder behavior, which we'll be talking about. It's really a niche area of understanding that you have to have in order to do this. And so obviously part of this presentation is that when you have limited company and government guarantees for lifetime income, it's important to find that elsewhere, right? And the value of that we'll be talking about later on in this presentation here, but that's kind of what we're here to kind of talk about. So let's talk about, well, how can an insurance company provide you with guaranteed lifetime income, right? So you're giving part of your retirement portfolio to an insurance company that has billions of dollars in reserves, and they're providing you with that guaranteed lifetime income. So it's an exchange, right? You're giving part of your portfolio to the insurance company, and they're essentially saying, hey, I guarantee to give you this amount every year for as long as you live. So the insurance company is investing in long-term bonds, as opposed to if you look at your retirement portfolio, it's primarily short-term bonds, because there's a long-term liability associated with long-term bonds. So unless you're a long-term holder, there's interest rate risk there. But the insurance company, they take on that risk because they are in the business of long-term liabilities. Whereas if you're not going to live, in retirement 60, 70 years. Insurance companies have long liabilities to account for this. So you're giving a part of your portfolio today, and in the future, the insurance company guarantees that they'll provide that set amount every year for the rest of your life. So it's pretty straightforward there. So let's talk about why it's important to have guaranteed lifetime income, and we'll be going into math examples later on. But the first is that it protects against downturns in the market, and that's pretty straightforward, right? Like if you have a part of your portfolio, you're guaranteed to get that every year. It doesn't matter like what the stock market performance is, right? You are guaranteed to get that every year, and we'll be going over a mathematical example about why that's so valuable. And the other thing, obviously, is that it protects you against you outliving your retirement portfolio. So it's insurance, right? Partly against market downturns, but also it's a hedge against longevity risk. You living too long, right? You can have a retirement portfolio, but if you live 50, 60 years, or depending on when you retire, that puts a lot of stress towards the tail end of your life, right? So it's important this is a way to essentially hedge against that risk, right? The third, which is really cool, I really love talking about this. Other people get bored, but it reduces the taxes on the income you get from the fixed income part of your portfolio, simply because of the structuring. Remember at the beginning, we talked about how to manage risk. It does something really cool with regards to return of principal. We'll talk about here. Two things: return of principal, and it defers taxation, right? It defers taxation from when you're working in a high income bracket to when you're in a low income bracket in retirement. And higher returns to your life expectancy. The returns increase the longer you live. This is really cool. Again, as an actuary, I get really excited about this because it's like, this is not underwritten. So if you're wealthier, if you are in great health, if you're a woman who on average lives longer than men, you get the benefit because that's being subsidized by everybody else, right? The average person who purchases this, and we'll be talking about that later, it's not underwritten. So there's arbitrage. So me as an actuary, I was like, oh my gosh, like here's the value, here's the embedded option that people aren't realizing. And that's why I get super excited, is because like, where else can you find this? It's simply a function of other people not understanding how to use it properly. But again, if you're wealthier, if you're in good health, then you're getting an arbitrage opportunity at the expense of everybody else. And the fifth one is also super cool because it allows you to take more risk with the rest of your portfolio, right? So a lot of what people do, they're super conservative, right? And so they're like, oh, they're so worried about running out of money that, they're super conservative with their portfolio. They don't want to invest in equities at all. But the issue is that then comes with the opportunity cost, right? Sure, you're protecting in the short term, but over the long run, your portfolio isn't going to grow. So you might be protecting it today, but then 10 years from now, 15 years from now, it might not be growing enough, which means you won't have income later on to support your needs. But what guaranteed lifetime income does is it provides you with more income from the fixed side of your portfolio, from the bond side of your portfolio. So what does that mean? If you're getting more income from the bond side of your portfolio, that means you're able to invest in equity markets longer. So that means downturns in the market, you're not as concerned because you have income safe and protected, and you can wait for the markets to recover. You're not so dependent where you're drawing down on the market in bad years, and we'll be talking about that later on in the presentation. And obviously the last is like peace of mind, right? But I always feel so bad when I talk to clients and they come in and they're so worried about retirement. They work so hard to get to retirement, and now it's just a stressful experience of like worried about losing money in the market and running out of all these worries after 30, 40 years of working. And like, so what this does is like, you're going to get income. You're guaranteed to get it. And then you're not checking the market every day to see how it's doing because like, look, I'm just going to invest in the long run. So there's a psychological benefit to having it as well, which we won't be focusing on in this presentation, but it's important for people to understand. I want people who work with me or anybody really to enjoy your retirement, right? What's the point? It's not about just having more money. It's about enjoying that process, right? Like if I can show you mathematically why this is better, hopefully it gives you a little bit of peace of mind here that you're doing the economically right thing. Obviously, if you read about it, guaranteed lifetime income annuities, super valuable economically, right? That's why I get super excited, but I'm not the only one. There's researchers out there. I'd encourage you to follow them. If you follow me on LinkedIn or Twitter, they're more active on LinkedIn, or not anymore as much as they used to be, but Michael Finca, David Blanchett, they talk about the value of this, and it's very academic. So it's a little bit super niche or like technical. So, but again, economists value this because of the same thing. There's embedded options that people aren't utilizing. So let's talk about why. Well, if annuities and guaranteed lifetime income has such great value, why do they have such a bad reputation? And the reason is oftentimes the manner in which they're sold, right? So they're typically sold by insurance agents, right? And insurance agents, are in the business of selling. And so what happens is people purchase things from professional sales people who are skilled at that, and then oftentimes they don't really understand what they bought, why they bought it, how it fits into a larger plan, right? And they don't always get the best annuity. They get something, they're focused on the caps and floors, and they don't understand how to use it, like the indices, and it gets super complicated. They don't really understand the value. So that's the number one thing about why it has such a bad, because then people get burned. They're like, what? They don't understand what they burned, and they go to cancel it, right? So that leaves a bad taste in people's mouth. The other thing, people are overly focused on caps, floors, indices, and not the guarantee, right? You're so focused on, okay, what's the cap on this? What's the floor? And that's not the value of these products. It's the protection. It's the tax deferrals, the financial planning benefits that come from it. So because people get so focused on this, they're focused on like new indices, volatility control, which while it has value, it's like you're focused on the minutia as opposed to the overall financial planning element. Like, why am I getting this? Well, how is this helping in my retirement plan? It's like, again, when you don't understand what you're purchasing, that's what leaves a bad reputation, especially when you're in bad products with super low caps, and like it's not really providing you anything. And if there are fees, right, some of them have fees, then like that negates the value of the benefit here, right? The other thing is people want liquidity. If you're investing in annuity, understand it's a retirement planning product, right? So you're investing for the long term. You should be investing as part of it. So if you're like, okay, I'm going to invest today and then I want to take it out in 2 years, 3, that's not really how these are meant to be used. So again, they don't understand how to use it, and it's a retirement planning product. And so you have to have that in mind. What is the value? Why am I purchasing? How does this fit into a larger plan? So let's just go over a couple examples of people we've actually helped, and we'll dive into kind of some examples here. So I helped a client from Ohio turn $500K of their retirement portfolio into $57,000 of guaranteed lifetime income, right? So that they get that amount every year for the rest of their life. Katie turned $300K into $43,000 of guaranteed lifetime income. So that's a 14% payout rate relative to the principal. And we'll be talking about all this in a little bit. Vicky from Phoenix turned $250K into $26K of guaranteed lifetime income. And again, that's coming from the bond side of their portfolio, not the equity side. But the equity side is investing for the long run. We'll be talking about that later. So what we'll be talking about here is how can guaranteed lifetime income reduce risk, improve wealth, and allow you to spend more in retirement. So let's look at a real life example, and then we're going off some numbers. I love numbers, and I understand people get dragged down by it, but it's important to just go over the high level info here. So here's an example. They're investing $1 million into a guaranteed lifetime income product. Current age is 55, so they're working, right? So this is, again, a key thing we'll be talking about later. So in a high tax bracket, they're investing. This is coming from the fixed income portfolio. They want to retire at 65. The amount of guaranteed retirement income they can get from this is $162,000, about 16.2% payout rate. It's a woman, so the life expectancy is 89. Like we talked about, the arbitrage, the men and women, if you're the same age, you get the same payout rate, even though women live longer. So, as an actuary, it's always better to get it on the woman, on average, right? Unless the spouse is the woman is in worse health. But on average, we're talking a lot of large numbers, right? The male life expectancy, just for, if you guys are interested, is about 87, right? So you get 2 extra years, right? Like it's the same payout rate, it just, you live longer. So the value is higher. Total payments to life expectancy, right? So it's 4 times, right, what they put in. And here's the IRRs, the pre-tax IRR. Again, I understand other people aren't IRR, but for me, it's like, here's the value. Where are you getting a 7% guaranteed IRR to life expectancy, right? And the after tax is 6%, right? Like, so where are you getting that from your fixed income portfolio? So again, this is why I really love the value of these products. So here's an awesome question. I love talking about this. Why are our GLI returns so high? Let's talk about that real quick. First, long-term bond investing versus short-term bond investing. So this is a technical topic. I won't go too in depth here, but understand that long-term bonds have higher yields than short-term bonds, but long-term bonds have have higher short-term risks because of interest rate risks. So if interest rates go up, you lose the current value of your long-term bonds. So that's why in your retirement portfolio, you won't see a whole lot of this, but you'll see a lot of short-term bonds as a way to protect against that. So what the insurance company is doing is it's allowing you to invest in long-term bonds, and they're covering the interest rate risk here. So that's part of where the yield comes from. The bulk of it comes from the next two things we'll be talking about. Risk pooling, right? So everybody purchases this product. It's not underwritten, right? So the value comes from that. People are buying this. They're pooling it. But wealthier people live longer, right? So people who are wealthier, healthier, they live longer. They're benefiting as a result of people who are not in great health, who purchase the same product, get the same payout rate, right? So there's a subsidy coming on here, and that leads us to the next point, right? Poor policyholder behavior with regards to income rider. So the way I want you to think about this is think about it like if you ever signed up for a gym. You signed up, you're paying the monthly fee, and a certain part you stop going, or you see a free trial for Netflix. You sign up, like, awesome, I'll cancel it. As soon as and then you forget. 5 months in, you're still paying for it, right? Not even watching Netflix. But the issue is, if everybody who signed up for the gym, if everybody who signed up for Netflix actually watched it every day, Netflix and the gym would have to raise their prices. And so what happens here with regards to the income rider is that people purchase the income rider. They're like, okay, yeah, this sounds great. But then they totally forget to actually use it, right? Like, so it's just poor policyholder behavior. And us as actuaries at the insurance company, we know this. We know people are going to behave like this. So we price it accordingly, knowing that, because we also know that if everybody opted in and behaved optimally, we'd be in trouble. But we know, again, it's a law of averages and numbers and policyholder behavior. People are not going to respond optimally. People like the idea of something, but actually executing it and valuing it are two different things, especially when it's not sold that way, right? You're sold on caps, indices, blah, blah, blah. You're not focused on the true value of it, which is great for the insurance company, right? Like, because we get to offer something knowing you won't exercise it. But now that I'm working on the opposite side, right? I'm like, this is where all the value is because other people are making poor decisions. The people who use it, again, it's a subsidy. It's a redistribution of benefits from people who don't understand what they're doing to people who do understand what they're doing. So that's why the value is so high. So now let's talk about taxes real quick. Clients get more after-tax income from the bond side of the portfolio. So I'm going to use a couple of quick examples. Again, I'm not trying to, I don't want to go too in depth into the numbers because people get lost here, even though, again, I get super excited, but let's just go over high level. Let's look at some numbers, see the difference on both pre-tax and after-tax. So Jacob is 65, has $1 million in the bond market that he plans on using for income. He needs $100K in retirement income. How much more after-tax income can he get from the GLI solution instead of the bond solution? So let's kind of look at that here. And then finally, we want to look at how much less does he need to take from his equity portfolio to meet his income needs? Again, he needs $100K in retirement income, after-tax retirement income. So whatever he's not getting from the fixed income side, he has to take from the equity side of the portfolio. Let's go ahead and look at that here. Here's just using a bond portfolio. Here's using guaranteed lifetime income. We're going to look at these categories: total income, taxes owed on income, net after-tax income, additional amount needed from the equity portfolio to meet retirement spending needs. So here we'll see that, again, it's a 4.5% coupon. So he's making $45,000 in income. That's taxable here. So the taxes owed, this is all taxable income, is $9,000, leaving him with $36,000 in after-tax income from the bond side of the portfolio, which means he needs $64,000 plus the taxes, right? He has to pay taxes if he's taking it out of his equity portfolio, right? Depending on his basis. Whereas on the guaranteed lifetime income side, he'd be getting $76,000 in income, and the taxes owed on the income would be very different, right? It's about $2,000 for 14 years, then $15,000 onwards. But ultimately, the after-tax income, $74,000 for 14 years, and then $61,000 for 15 plus, are significantly higher than the after-tax income he's getting from the bond side of the portfolio here, which means ultimately, that's less that he needs to take from the equity side of the portfolio. So the equity side of the portfolio is able to compound more. And we'll be talking about this in more detail in the next few slides. But I really want this to hit home for you. It's like, if you're getting more from the fixed income side of your portfolio, so you not only are getting more income, but you're allowing your equity side to compound more. Okay, so let's just talk about the higher after-tax income due to return of principal. A lot of you probably looked at it last side. Well, wow, that's a lot. Why are the taxes so low? And remember, we talked about structuring risk. The reason why is that it just structures the bond income differently, and we'll go into that in more detail here. So an annuity provides, with the guaranteed income rider, provides tax-free return of principal every year, unlike a bond. When a bond, you only get your principal back at the end of the term, right? So part of the annuity income is return of principal, which is not taxable, instead of a bond maturing at the end of the term. And so I'm going to look at that real quick as an example here. So assume you have a $1,000 20-year bond paying a 4% coupon. So that means with a regular bond, you're getting the coupon every year. And at the end of 20 years, you get your $1,000 back, right? And we're going to compare that same thing to a 20-year bond, except instead of waiting 20 years to get the principal back, we're slowly getting a little bit of that principal every year. So take 1,000 divided by 20. So I'm getting $50 of principal back every year, as well as this coupon, which is about $40, right? So let's look at those two things and then look at the net result here. So here's a bond investment return of principal at the end of 20 years. It's at the $1,000 again. Here's my yearly payment for 20 years. I'm getting this, and that the final payment is $1,000. The total payment is $1,800, right? Versus if I have $1,000 and now the yearly payment is no longer just 40, it's 90 because I'm getting a part of the principal back every year, and then the final payment is zero. But even though the total payments are the same, the time value of money is different, so the IRRs are different. Right. And think about it again. This goes back to the concept we're talking about earlier. If I'm getting more income from the after-tax income as well, like this part doesn't focus on taxes, but you're also getting more after-tax income. That's more that can be invested elsewhere. And that's why the value of it is significantly higher. Right. So again, it's just a structuring of risk. We're not waiting till the end to get $1,000 back, our principal. It's slowly being given back to us over time, which is a better, more efficient for the consumer when we talk about fixed income. Again, just managing risk better, right? We're not taking more risk, just managing it better. So this is pretty straightforward. Hopefully everybody who's on understands the concept of, look, it's difficult to go from, working a job where you have a set amount of income coming up every year or every month, rather, your expenses, you take one to pay the other versus being all of a sudden giving up that source of income and depending on your portfolio to provide income, right? And there's no real way. It's not like it's not a pension. They're like, okay, we're going to give you this amount every month and you don't have to worry about it. You essentially have to manage that. And unlike a job where, if I go to work, I work my hours, I'm going to get this income. Like this, how the portfolio done is not out of your control. You can get up and go to work every day and that's in your control, but portfolio returns are not. And so managing that up more appropriately is super important. But this is also what makes it super scary, as well as like what we'll be talking about is if you spend down your portfolio in bad markets, you can run out of money. And we'll be talking about that here in a second here. So when we retire, it requires a shift in how we think about our habits and our behaviors to go from essentially a saving mentality to spending. How do we actively spend? How do we spend more prudently and economically, right? So it's a different mindset to go from saving to spending, right? So again, it's a different strategy, and the analogy I really love to use is like this mountain. We're like climbing a mountain, where at the beginning, we start at the bottom. We don't have a lot of money. We just graduated college. We're trying to save, but we're trying to get to this final destination, right? Which is retirement. This is where the flag is. We're all trying to get to. But the issue is like we spend so much time trying to figure out, okay, I just have to get to retirement. We just have to get to retirement. But people don't realize that once you get to retirement, you still have another 20 to 30 years left to live. And so you spend all your time figuring out how to get here, but not how to descend, right? Like, how do I spend? Okay. And it's a different risk profile, right? I don't know how many of you are out here have gone climbing or sat at top, but it's a fundamentally different risk profile from being at the bottom looking up to being at the top looking down, right? Because, the upside of being at the bottom, right, is, like, okay, sure, retirement seems forever away. I don't have much income. It seems impossible to get there, but I also know I just have to, slog through it, right? I slog, I work, I save, I slowly get income raises and I'm contributing to it. But the upside is also that being at the bottom is like, if I make a mistake, right? I didn't lose a whole lot. If I take $10,000, I bet it on crypto, I lose everything. It's like, okay, that might be a mistake, but it's a very cheap mistake, right? As opposed to when I'm at the top, right? Instead of $10,000, I have hundreds, thousands, or millions of dollars, right? Like the decisions I make here have a significantly more consequence because there's more weight behind those decisions. And so when we think about this, like the benefit of being at the bottom is that gravity is also protecting us, right? It forces us to be more prudent in our step, right? It prevents us from going too fast up the mountain. But the opposite side is the side of the coin. Is when we're at the top, gravity is no longer our friend. Gravity is at our back, pushing us down. We have to be more careful with our step. Otherwise, the momentum will force you off the mountain. And small mistakes can contribute to that. Small mistakes you make here, right, can lead you to falling off the mountain, to running out of money. And unfortunately, what I find with a lot of people in talking about retirement planning is that they're not only have they spent so much time trying to get here, they haven't planned for this, but also when they get here, they're afraid to look down. They're actually afraid to look, what do I have to do? Because then again, getting the anxiety, right, like of having to address something and change your mentality and change the way you look at the world is shocking for something they haven't been prepared, right? So what I love is trying to tell people, like, look, the more you plan here while you're on your way up, then the less scary this becomes when you're at top, because you're just more prepared to go down. And one of the things we'll be talking about here is kind of like the consequences of like poor planning, as well as simple mistakes in how you manage your portfolio, and that can occur here. So. Okay, so let's talk about how small misstep can lead you to fall off the mountain. So I really love this. Again, as a math guy, this is one of my favorite examples. So we're gonna look at two people. John and Mary each have $1 million saved for retirement in the stock market. Let's say the S&P 500. Both plan on taking $50K a year in retirement. So it's about a 5% withdrawal rate. The only difference is that John retired in 2000 and Mary retired in 2003. Right? So they both have $1 million, retiring with $1 million. One retired 3 years later than the other. The question we ask is, who had more money at the start of 2026? So we're going to look at our chart here. I'm going to preface this: historical results do not predict future results. Here's the y-axis, the amount of money from 0 to 6 million. On the x-axis is time, right? Here's 2000, one person's retiring. 2003, Mary's retiring. Again, retires in 2000. John is in red. Mary is going to be in green. So let's start with John. He starts with $1 million, and he starts making his 50K withdrawals, right? The issue is that 2026, he's only down to $96,000. So he's going to run out of money in the next 2 years here. However, Mary also retired with $1 million 3 years later. However, she retired in 2000, but at the start of 2026, she has $5.7 million. So hopefully the question everybody should be asking is, like, why does retiring 3 years earlier lead to John running out of money, whereas Mary has $5.7 million, right? So let's take a look at that here. So obviously, taking one of the things I want to emphasize here is taking early losses in retirements really leads to long-term wealth erosion. So we really have to look at, well, what was happening during those 3 years? So in 2000, I don't know if any of you remember, it was the dot-com bubble bursting. So you had 3 years of really negative returns, negative 10%, negative 13%, 23%. Versus Mary's returns were really positive. She had a huge year in 2003, 2004, 2005. So even though John had those same years, right, in 2003, the issue is he absorbed so many losses that the positive returns were not enough to make up for the early year losses. So in economics or retirement planning, we call it the sequence of return risk, because the sequence in which you have returns significantly matters, right? Like, and this is what caused the disparity here, and this is what you want to protect when you're at the top of the mountain, right? You want to protect yourself against these negative, because I don't know what the market's going to do, but by simply planning it better, managing the risk better, we can protect against these outcomes, right? So those 3 years really devastated John's returns. So let's just look at, like, just mathematically why. Again, let's say you have $1 million, you have a 50% downturn in the market, you're at $500,000. What you need to get back to $1 million is not 50%. So if you came 50% down, you need 100% or to double your money from 500,000 to $1 million to get back. And that's why it takes longer to recover, right? From the losses. So the issue is then obviously if you're taking withdrawals at the same time, so I have my 50% withdrawal, then I'm taking 50K withdrawal. Now I'm at 450. I no longer need 100%. I need 122% just to get back to where I started. So you can see this starts in a cycle, right? Like I'm going down this hole, which makes it impossible to recover from. And this is what happened, the difference between John and Mary. So that 3 years sounds like not much, but mathematically, this is what happens. So the question, is how do we protect against this? How do I increase my chance of meeting my retirement income goals and the wealth I have later on in retirement? And that really involves just managing risks, right? So protecting yourself in the short term so that you can invest for the long term. And the way to think about that is to understand the place of bonds and stocks in our portfolio, right? Bonds provide protection and income, stocks provide growth. So the bond portfolio, safer in the short term, but lower earning over the long term. We'll be talking about, again, historical results here, but it's important to understand how to use this in your retirement planning. Your stock portfolio, riskier in the short term, but higher earning over the long term. So it's more volatile. And we're just going to be looking at historical results here. So here's the bonds, here's stocks. We're going to be looking at compound annual return, largest loss in any 1 year period, largest loss in any 15-year period. So from the compound annual return, you can see obviously that the stock market is about 50% higher, right, than bonds over the long run, right, for during this period. But bonds have a lower downturn, or here is that the largest loss in any one period for bonds is only 16%, whereas stocks are 42%. So it's a lot more volatile. So again, stocks riskier in the short term, but higher earning over the long term, right? The thing what I get to try to tell people is if you expand your width from 1 year to 15 years, there hasn't been a loss during this period. Again, it doesn't mean that's not going to be in the future, but understanding that there's less risk in the stock market over the long run than there is in the short term. So if you can kind of think about it that way, it's like, I just really need to protect myself in the short term so I can invest in the long run. This is a way to essentially accomplish that goal. And this is ideally how bonds should be used, but for the sake of simplicity, it's not often done that way. You just mix the two together, and you're not accounting for it in the way it should be. So bonds provide for income and short-term protection. Use stocks for long-term growth. And so, I'm going to go over a bucket approach. You probably have heard this before. It's just understanding how to balance between stocks and bonds. And understand how guaranteed lifetime income kind of fits into that. So it's pretty straightforward. A bucket, one, your safe assets for short-term spending. Bucket two, your growth assets for long-term investing. This is my cool little avatar I made here. Here's your safe investments. Here's your growth investments. Again, the goal is to protect income during market downturns while allowing growth assets to compound, right? So you're using safe investments for spending. Your growth is for investing long-term. Question, what goes in the safe bucket? Cash, CDs, bonds, guaranteed lifetime income. We're using this for income. The purpose of this is to provide us income, right? This growth is for long-term investing, and income we'll take in the future, but this is for immediate income. Life insurance vehicles, if you're high tax bracket. Your growth bucket, stocks, hedge funds, alternative, private equity, commodity, anything that can have higher returns, but you need a longer investment horizon for. So how do we use this? Essentially, we're going to spend down the safe investments, right? Like that's coming from income. We're allowing the growth investments to grow for the long run. But what happens is as the safe bucket decreases, the growth investments, those are going to grow. And then we just pour from one into the other. It's just rebalancing, right? So safe investments provide stability and protection, used for spending. As markets rise, you pour the gains into here. So growth investments that drive long-term wealth creations, you let them grow over time. Then you move into the safe bucket for spending, right? So this is the way to think about it is, again, get more income from your safe investments so you can invest more for the long run, right? You're just doing it more prudently. You're managing risk better. You're managing the tax consequences better. And you're getting more after-tax income, which allows you to invest longer over the long run. So here's, again, numbers, what the question, let's go back and look at John, who retired in 2000, is what if he had used more of a bucket approach in 2000 instead of investing all his money in the market? So John has $1 million saved for retirement and retires in 2000. He needs $50K per year in retirement to meet his spending needs. So instead of investing his full $1 million in the stock market, he uses more of a bucket approach here. So invest $600,000 to a bond strategy that will pay him a guaranteed $50,000 a year for the rest of his life. So this is the guaranteed lifetime income solution. He keeps $400,000 in the stock market. How much more money would John have had at the start of 2026 if he used this Colva bucket approach? Again, here's a graph, historical results. John stocks only approach, John Colva bucket approach is in green. Again, stocks starts at $1 million, 96,000. We saw this already. Starts at $1 million, protects himself with this guaranteed lifetime, and he's meeting his spending needs of $50,000, and he has $3 million at the start of 2026, right? So again, simply by protecting against this and thinking more prudently, right? Him taking more risk at the beginning actually hurt him. Taking more risk in general leads to long-term wealth over the long run. But if you don't protect against short-term risk, right, then you'll actually end up having less and significantly less, right? And at the danger of running out of money, right? So how does adding bonds or GLI to a stock portfolio change retirement outcomes? Again, John is 60 years old, has $1 million saved for retirement, retires in 2000 needing $50K per year. So obviously, if you looked at the last slide, you're like, okay, Rajiv, that makes sense. I want to protect myself against that. But can't I do that using bonds? And you absolutely can, right? But one of the things we showed here is that through guaranteed lifetime income, you get more income from the fixed income side of the portfolio, right? So let's compare that. Let's actually see the value of comparing, the bond side of your portfolio to guaranteed lifetime income. We'll do that here in the next few slides. So we're going to compare stocks only 100% invested in the S&P, which is our baseline. We're going to do stocks and bonds, a 40% S&P 500 and 60% bond portfolio. Remember, we use 60% of this $1 million portfolio to meet his spending needs. So it's only fair to compare a 40% S&P to a 60% bond portfolio. And we're going to compare that to a 40% S&P, 60% guaranteed lifetime income annuity, providing that $50,000 a year, right? So we're going to compare these outcomes and see how it improved John's positions here. So again, here's a graph again. We're going to have the stocks only approach, 40% 60 stocks, 60% bonds approach, the stocks and GLI approach. And this doesn't account for taxes, and we'll be talking about taxes in a second here. Again, $96,000. Now using the bond approach, instead of instead of 100% stocks, it's significant improvement, right? So yeah, bonds protect, you use better than taking the full risk, but not as much as the GLI, right? So the GLI overall has about $3 million. And what you might be noticing is over the long run, this is a better way to do it. But you might be noticing, well, the bonds provide more value here. And there's essentially a break-even point at which GLI kind of really allows it to take off. And the value is because part of this is coming from the income rider, right? So bonds allow for more short-term protection, but the value is when you turn on the rider, right? And so it takes, there's like a calculation, kind of like Social Security, right? Think about this way. When should you take Social Security? Well, it really depends on your health, right? Like if you're in poor health, you really want to take Social Security right away. But if you're in great health, you want to delay taking Social Security. There's a break-even point you can calculate with most people in Social Security. It's about 81, 82. And the average person, if you're wealthy, professional, not average American, but, you're better off delaying. And the same thing happens here. There's a break-even point here where the income annuity, really takes off. And we're going to see it, and you're getting more income from that side of your portfolio allows your equity side to really take off. So in this case, the pre-tax, your break even is at age 82. Again, your life expectancy is 87. Again, this is a man. A woman would be about 89. And this is pre-tax, right? So if we account for taxes, how inefficient, the bond side of the portfolio is, the break even changes, right? The break even is now 79. And then again, an LE age of 87, right? So this is how kind of using GLI and thinking about it over the long run and doing our planning more appropriate. This is the value of it. Like from 79 on, so if you're going to live past 79, this is, if you do joint, it's actually even better, this break even point. But the way to plan for this, it's protecting you against this. It's providing you more income. Again, you're getting a 7% guaranteed return here to life expectancy. So one of the things we do with clients is we do retirement income analysis that can quantify the value of doing this in two senses. What is my chance of meeting my retirement income goals? Two, how much after-tax wealth can I expect to pass on, right? So here's a sample case from a client. The client had 55, married couple, had $3 million saved. And so they wanted a standard kind of 60-40 type approach. The issue, they had $3 million, but they wanted about $250K in retirement, 10 years from now. And obviously that's a lot. That was a lot of strain on the $3 million portfolio at 55. So even though they had 10 years right before they wanted to retire, that strain was too much. The income strain was too much, such that their chance of meeting that income goal was only 56%, and the amount of after-tax wealth that they would pass on would be about 1.5, to their beneficiaries, right? But by using guaranteed lifetime income, we improve two things, right? Their chance of meeting their retirement income goals from 56% to 74%, but also the after-tax wealth that they passed on, because they were able to get more income from the fixed income side of the portfolio and allow the equity side of the portfolio to grow, right? So this is the value of kind of retirement planning and thinking about these things more proactively. And this is essentially what we help clients do is, yes, guaranteed lifetime income. I love the product because of everything I just talked about here and how to use it, but you have to understand how to use it as part of your plan, right? Like if I sell you the best product, but you don't understand how to defer income, use it with your tax planning, use it with the fact that there's a 0%, capital gains tax rate up to 146,000, you're not using the full amount of the value. So guaranteed lifetime income, I love this. It's my favorite product out there. But again, use it as part of a holistic plan, right? Like to get the maximum benefit out of everything. And that's, again, going back to that managing risk better, that's all I'm trying to get you to understand. It's like, how do I just manage it better, without taking more risks? Just thinking about structuring it a little bit different. Again, these are the client examples that we kind of went over earlier on the presentation. Of people we help. So if this is something of value to you, I'd love to work with you on implementing this as a part of your retirement plan and portfolio as well. I see there's some advisors on the meeting too. So if these are things you're working on with your clients, happy to work with you on understanding the value of that and how to implement it for both you or your clients. So that's essentially our presentation. You can follow me on LinkedIn, as well as I have a Substack called Separating Value from Bias, where we talk about a lot of these things like the bias against insurance products versus the actual value that they have. If you're interested in any of these solutions, please do reach out, as well as, we'll probably be following up with you after this webinar as well. If you guys have any questions, I'll take questions here. Are you able to? Okay. Yeah. So I think the chat's working, but I don't think anybody has any questions here. Okay. Well, if there's no questions, I'll end the webinar here. But I do want to. Oh, we do have a question. Oh, thank you for attending. So thank you. Yeah. Thank you to everybody for taking your time to attend. I hope you learned a lot. I hope this was super informative. I hope you were able to use some of what you learned here to make better decisions for your own retirement planning. Because at the core, I'm an educator, I'm an academic. So hopefully you got a lot of value out of this. And I'll be following up with you here shortly. But thank you all again for your time and for attending. And I really do hope you learned a lot.